The investment world's greatest challenge isn't finding alpha, it's truly understanding what's driving your returns. While fundamental analysis excels at company-specific insights, there's a critical element many firms overlook: systematic macro exposure. Step 1. Identify the problem. We've all been there, running correlation after correlation, testing assets against inflation, rates, oil prices, creating what amounts to a factor soup that generates more questions than answers. This approach is neither quantifiable nor repeatable. Many portfolios appeared neutral before exogenous macro shocks, yet suffered significant losses. The painful truth? There was macro in your residual. Step 2. Decompose returns systematically. Our macro factor equity risk model takes a different approach. Like traditional fundamental risk models, we decompose returns into explainable components, but with a crucial difference. We focus specifically on macro factors, which traditional style-based risk models miss entirely. Step 3. Answer the critical questions. At its core, our framework answers 3 essential questions. 1. Does macro matter for your specific assets or portfolio? 2. If so, which macro factors are driving performance? 3. Are you being compensated for the macro risk you're taking? Step 4. Apply insights to portfolio construction. With macro exposures quantified, you can now make informed decisions. Whether you want to reduce unwanted macro sensitivity, maintain exposure to beneficial macro factors, create truly macro-neutral positions, or tactically position for macro regime shifts. The key is that these decisions become deliberate rather than accidental. Consider this real-world scenario. You've constructed what you believe is a market-neutral, sector-neutral portfolio. Your optimizer has reduced style factor exposure. On paper, you're fully idiosyncratic, pure alpha. Then, Q1 2020 arrives, and lockdowns shutter Western economies, or 2022, when many stock pickers didn't realize how exposed they were as the Fed started to hike interest rates. Both were periods where many neutral portfolios suffered losses of 20 to 30%. Being factor neutral isn't the same as being macro neutral. Macro exposure isn't static, it's environmental. You might go months with minimal macro sensitivity. Then, suddenly, inflation concerns or a shift in the Fed's policy stance might suddenly create new narratives that dramatically impact your portfolio. In today's interconnected markets, understanding the macro DNA of your assets isn't optional, it's essential. Even if you choose not to actively manage macro exposure, knowing these hidden risks provides critical context for your investment decisions. The question isn't whether macro impacts your portfolio, it's whether you can see it coming and turn it to your advantage.